Hello, OpEx, my old friend. I've seen the VIX spiking again. Without the Qs slowly creeping down. That's all I got. Hey,
It's not the
everybody.
same without a sweater vest. I think you need
No,
or
it's not.
a turtleneck. You need a sweater turtleneck.
I was just saying to my friend and substitute producer here, Dylan, that damn, I look good in a turtleneck. I gotta get me one of those. Yeah. Holy God. Welcome, everybody, to a special weekday edition of the Weekend Rip here on Stock Twits. I don't know about you, but I am up stocking my twit right now because the markets, look, it feels like we're down a lot more than we are, but I suppose that's just what happens when you're stuck in a melt-up. With me this week, this month, to celebrate OpEx is none other than Cem Karsan. Cem, thank you very much for joining us. He is, well, that's not a picture of him, but, you know, that's what we were going for that we've just tossed up on the screen.
Saying you're Garfunkel, but now that I see Simon's hair, you know, I kind of want to be Garfunkel. Can I be Garfunkel? Yeah.
Yeah, you can be Garfunkel. Why not? I don't know why, what's his name was sporting the micro bangs that like Gen Z women like to sport these days. Anyway, the inspiration for this week, in case you haven't noticed, is the 1967 classic from The Graduate and the soundtrack done by Simon and Garfunkel. Yeah, lots of interesting things were going on in 1967. Well, I got the log line right here. Benjamin Braddock, Dustin Hoffman, has just finished college and back at his parents' house. He's trying to avoid the one question everyone keeps asking. What does he want to do with his life? What does the SPX want to do? Good God, Jim, what's going on, man? Holy God.
What I love about that song, and first of all, 67, like, you know, we've been talking about the similarities between the 60s and 70s. So, but that song's about, you know, people basically not listening, not talking to each other, not listening to the truth. It's all about narrative, cultural emptiness, right? You know, people talking past each other. That just rings. I feel like it rings so true for where we are right now too, and that's probably not a coincidence, given we've talked about the populism and everything that. I think this is apropos for today in the discussion.
Yeah, history does indeed like to rhyme. And by the way, I was just a quick aside before we dive in here. I'd like to address some of the Gem haters. Some of them, man, some of these people have no concept of personal accountability, responsibility, and everything that comes with those things. My guy here, Jim, is doing a service for everybody, trying to better understand markets. If things don't go exactly the way he says them to a T, I'm sick of all these whiners being like, this guy didn't, he was off. Just shut up. And furthermore, suck it. So there, I just wanted to get that out of the way off the top. Speaking of the top, man, I don't know if you saw, but Chamath Palihapitiya just, I think he might have signaled the top because he's coming out. He's got another SPAC, man. He just doesn't learn.
Well, listen, that stuff, he was issuing them for a good year there last time around. So
I remember.
Yeah, just because the first one's coming out doesn't mean it's over. But we'll talk about that today.
Yeah,
definitely is a sign of a little percolating retail mojo.
Yeah, I've got some other signs here. We've got the return of meme stocks potentially, although it kind of, some of them feel forced, like a forced meme, and we all know you cannot force a meme. And I'm talking, of course, about Open Door, which is a former SPAC that Chamath brought public. You got a ton of AI hype. You got the famous pay packages that were going, that were making headlines from Meta. IPOs are really hot. You had Circle and oh god, CoreWeave. I'm forgetting a few others. Bitcoin and Ethereum, of course, at all-time highs, and then Palantir sporting a $400 billion market cap. I mean, all the signs are there, but as we all know, you know, it sometimes just takes time for these things to roll over, because at the same time it feels like everybody's recognizing them. And to throw back to an old reference you used to make about Gary, we got when everybody's prepared. And sure enough, today I was seeing that there was a ton of volume going off on super far out of the money puts on the queues, and I'm like, oh, we're not going to drop then if everybody's immediately running for those puts once more.
I'll add to that too. I think it's important because you connected the meme thing, but those things connect, right? When the vol is this compressed, we've talked about this, but dispersion happens, right? The vol is being compressed at the index level. And this is part of why we, at the Summer of George, which we've talked about on here, beginning of Summer of George last year and this year, we were very clear. One of the things that goes with that is the running of the memes. The running of the memes happens because the index gets compressed and everything has to move away from each other. And in the summer, guess what? Hedge funds are short the memes because they're nothing burgers. In the long run, they will go to zero. But whether they go to 10,000 times that price before they go to zero is another story. And so in a low liquidity environment with large long short equity exposure at hedge funds, vol compression, forced dispersion away from each other, what happens? You have the greatest degrossing event since COVID. That's what happened this summer. Hedge funds degrossed at the same size and scale that they did during COVID. That's what happened this summer. So, and that was driven primarily by the confluence of a massive growth in long short equity exposure, while structural product issuance has also dramatically grown, and a low volume summer where the vol just gets compressed on the index level, pushes everything away from each other. That pain starts in long short. It's too big for the market. And that degrossing then drives it even further away from it. And then guess what? Retail gets in the game and starts squeezing. Not that they understand necessarily all that, but that's the flows that structurally drove this the majority of this summer's rally. So the two things are connected. The running of the memes and the vol compression and Gary that you're talking about are intrinsically connected.
Yeah, sometimes just as a trader, when I'm doing particularly well, like I have been this summer, I have to stop and second guess myself and go, okay, am I doing well, or is this just a product of it being kind of like throwing a dart at whatever and just getting lucky because of this dispersion going on,
Yeah, I mean, it's a narrative, which is what is the easiest game to play, right? It's like a momentum story. Works incredibly well in low liquidity vol compression.
Yeah,
that's the story. And so when all of it, which is the majority of the time, when liquidity comes back and vol is not as compressed, which is rare, that starts to mean revert. And I think as long as you got your environment right, there's a bon ton roulette, let the good times roll.
Man, we're speaking French on here, gang.
Oui, oui.
Parlez-vous gamma? Because we got some, according to, I really hate referencing this clown, but Zero Hedge posted that on into Friday's OpEx this last Friday, dealer gamma was the highest ever. And if you could break that down, and I'll try to interrupt you and ask in layman's terms, what exactly that means and what it's been doing for the price action these last few weeks.
Yeah, so I want to be clear. When you say the highest ever, you also have to realize that volume and options is increasing. Like every expiration is almost the highest ever. At least each quarterly OpEx is. So it's a bet. If you go back and look at Zero Hedge, pretty much every quarterly OpEx for the last 5 years, they've been saying it's the biggest ever, because it is. But that doesn't mean that, hey, it's usually lower and now it's higher. It just means that's growing each time.
It's just increasing in popularity as time goes on.
Yes. I mean, here, let's back up let's talk about that. But I really want to do it in the context of a much bigger conversation, because I think that's important. One, stocks and bonds, if you include private equity, private credit, if you include even real estate in that, which I think is kind of their businesses, essentially assets, $500 trillion of assets globally. It's a mind-boggling number, but 500 trillion. The reason I tell you that number is to put it in context to what's going on in structured products and hedge funds and everything else. This is like probably the most important thing that we could talk about. On the other side, you have non-correlated assets, or at least things that are perceived to be more non-correlated from stocks and bonds. And those are, I'll name 4 of them. One of them, talked a lot about on the show, crypto. Another one, precious metals. But then there's 2 more that are really growing, structured products and hedge funds. Okay. And if you put all 4 of those together, let's go through each one in the current size. And also let's talk about how much they've grown in the last 2 to 3 years. Okay. Crypto is now $3 to $3.5 trillion. Just 3 years ago, it was $1 trillion, right? Precious metals, 22 trillion, much bigger, but about 17 trillion of that is buried underground at sovereign funds. So like it's not owned other than just at central banks. That number is up 3-fold in 3 years. So it was 7 or so. Now it's 22. And by the way, the amount that is invested has gone from about 1 to 5. So let's say 5 trillion it was 1. All right, let's go to, we've done precious metals and crypto. Those are more assets, and you could argue whether they are or are not correlated or non-correlated. Hedge funds. Hedge funds have gone from 2.5 to 4 trillion in 2 years. Structured products, I talked about a lot, have gone from 500K, and I'm including ETFs and structured notes because they do the same exact thing, 500K to $2 trillion. All of these have taken on massive assets and have seen dramatic growth. And people are like, can this still go on? Whether we're talking about crypto, gold, or hedge fund assets and their effects, they have different roles and how they affect the market. But if you think about it right now, we have a total, if we add them together, let's just say 5 for precious metals, because again, 17 of that's underground. 5, 3, let's say for crypto, and then you have 2, right, for structured products, and 4, right? We have about $14 trillion. Up, mind you, from like 4 just 3 years ago. 14 trillion in the context of $500 trillion of other investable assets, which are all pretty much correlated. If you want a bull case for crypto, if you want a bull case for precious metals, if you want a bull case for hedge funds and structured products, there it is, right? And this is in the context of markets going up. For those 500 trillion being, again, les bon temps roulés, like the good times are rolling, like people are swimming in it. They're not, we're not exactly moving away. We're launching SPACs. But people are moving away because they realize we're at all-time records in valuation by many metrics above 2000 in the tech bubble, which, by the way, I started my business, my time in the industry in 98. If you told me right now, like in 2001, 2, 3, that we would see those kind of valuations again in my lifetime, I would call you insane. Not that we wouldn't see bubbles somewhere, but the whole market being at those valuations again. I mean, the amount of pain tech bubble was NASDAQ lost 92% of its value from peak to trough.
Jesus.
And 98% of tech startups went bankrupt.
I can't imagine that happening again today. It feels like the world would be over.
It will. You can show this video when it happens. And the haters will find a way to hate still. It's going to happen. You don't trade at these types of valuations. This is a bubble. By the way, Sam Altman came out this week and called it a bubble. The tip of the spear in the bubble is calling it a bubble. That doesn't mean it's not going up in the short term. I want to be clear. Like it was the tech bubble was a bubble in 98 and it rallied for a year and a half and doubled before it lost 92% of its value. Question is, how far will the bubble go? And that's not a function of, that's the voting machine, not the weighing machine. And we'll get into that. And I think people get confused between those two things, predicting the next week and next month has nothing, literally nothing to do with the long-term outcome or little to nothing. sometimes counter-correlated because people are getting short right into a bubble because it's a bubble. And
Right.
guess what? That leads to more forced demand, like we saw from hedge funds this summer in that scenario. But importantly, back to our conversation about 500 trillion versus the alternative, people need to find alternatives. And by the way, 2000 was a bubble, similar valuation, but there were not remotely the number of risks that there are right now. I want to be clear about that. We had just seen in 2000, we had just seen the fall of the Soviet Union, the only adversary to the US. It was a feeling of geopolitical bliss. If you were alive during that time, people listening that were around then will corroborate this. The feeling in 98, 99, 2000 as that the US would never have a rival again ever, at least not for 50 to 100 years, and that we were in a time of geopolitical peace that would be never ending. That was the sentiment. And by the way, we were in a budget surplus. We were
Good
literally in a
times.
budget surplus.
Yeah, Bill Clinton
Okay.
was partying in the Oval Office with that one lady.
You cannot, Monica Lewinsky.
Yeah.
Yeah.
He was celebrating.
Yeah, celebrating, as he should have been at the time, right? Should have been celebrating. Maybe not that way, but celebrating nonetheless. And my point is, we are at the same valuations, but it's not just about valuations, it's about risks, right? The Fed was just in the process of lowering interest rates and finding a new lower, like the Greenspan in 96 said, you know what, the natural state of unemployment, it actually could be much lower than we thought, and started the process of monetary stimulus that we now see. That has just begun that. We are past all that. We are post all that. We are in a massive budget deficit. We are being rivaled by China, and in terms, it's a different world that we live in. And so understand that yeah, this is a bubble. There's not a question. It's not like is it or is it not? The question is, how long will the bubble go before it bursts? And that answer could be years. It could be. I'm not saying it's likely to be, but it could be. Anyway, we'll get more into that. But the 500 trillion versus now 14 trillion, up from 3 or 4 or whatever number you want to put on that, is a dramatic change. But it is also just the beginning, in theory, of people trying to find a way out the door. And what happens when people need to actually, these are the people that are ahead of the curve, right? What happens when the other, 500 trillion needs to head out the door? And the answer is that door's not very big, and those people will be late. But when they are, guess what? The other hedge fund assets and the crypto and the gold or anywhere else that is even remotely a place to hide will explode with assets and will explode in price and, importantly, market structure effects. And so the structural effects that we're just starting to see from the growth of hedge funds and structured products alone, which are the two that actually have reflexive effects on the actual market. The other two, you could argue, do or do not. Crypto will eventually, I think, but not yet, really. Those two things are having in the summer had dramatic effects on the outcome, and increasingly will have even more. And so these conversations we're having about those things, you think they're important now, just wait. And that's the reason I bring that up now, back full circle to your point about the biggest gamma exposure ever, is because every options expiration is essentially the biggest options expiration ever. And the growth is exponential, not linear. We're hitting a tipping point where these are more non-correlated products. They are going to eat the market. They are eating the whole market. We've talked about that. But the more volume there is in it, the more they're used, the more there's a need for them, the more effects they'll have. And at some point, again, probably be bigger than the equity market itself. But again, as of now, just from 2.5 to 4 trillion for hedge fund assets and 500 billion to 2 trillion in assets, their growth is starting to have dramatic effects. And we can dive into those. Let's answer your question directly about gamma. yes, big expirations, all of them. If you just look at the turning points in the last several years, it couldn't be more clear how important these are. If you don't see it by now, I can't help you. Now, if you want to know exactly what that means in terms of the outcome each time, we can play probabilities, but it's not the only effect, right? And we'll get into kind of those parts and how they are affecting things in general. But they're interacting with other parts of liquidity. What happens with these positioning is not like, oh, we're going up or we're going down, or there's gamma here, so we're going to not move, or we are going to move. What it does is it changes the distribution of outcomes.
Mhm.
It doesn't change necessarily the expected value of where things are going. And so this is why people get frustrated, because they're like, he's saying up and down at the same
Yeah.
time. Like, sure, I can do that. We're going up or down. No, that's not the point. There's a tremendous amount of value in understanding the distribution. What does that mean in terms of potential outcomes and likely path of outcome? That's very different than up down. I can pick out two paths, one up and one down, and I will actually right now for you, that are incredibly more likely than all the other ups or all the other downs. And by knowing that, you can bet on both incredibly profitably, right? Without just being long or short the market. And I think that's very important. Let's walk through that actually as an example. Right now,
Well,
and I
just real
highlighted, sorry,
fast. Yeah, real fast. I just want to make sure I do this as often as I can because the reinforcement helps me. But the structured products that you talk about, that these hedge funds are engaged in, that these institutions, market makers, dealers, all kind of synonymous. Uh, Basically, in an environment where there is little yield to be got to little profit to be gotten elsewhere, they've basically found this avenue of like, hey, we figured out that we can sell these structured products, which are essentially selling options on the S&P, on the VIX, you name it. And just in a really dumbed down way, it creates this buoy effect under the in the market that just kind of, it's a perpetual, just kind of always keeping it afloat because there's always this underlying bid from those structured products, whether they're short options or whatever it is. When they eventually have to cover them, it's just creating, and there's billions of dollars doing this, that's kind of keeping it afloat. Is that basically
let me clean
what
that
it
up a little.
is?
You're largely correct, but let me clean it up just to be very clear. First of all, who are uh, issuing and who are buying these structured products? They're not actually hedge funds that are buying them or issuing them. Hedge funds are a separate thing. Um, Banks primarily are issuing them, and they're just structured options positions. It's a way from taking an options position, which is complicated to people, right? And just telling people, I'll give you this payout if X happens or Y happens, then you make X. If not, you make Z. That's basically what they're selling. It's a structured payout. They're selling a structured payout, and these are growing dramatically in popularity. And I'll get to kind of the why. But who's buying them? Primarily RIAs, meaning entities who are investing on behalf of individuals and other institutions. They are buying these on their behalf. Okay. Why do banks do this? Because it's very profitable. They charge really high fees and they take little to no risk. They'll go hedge it out in the real options market. So when a bank does this, issues this, they get long the other side of this trade, and then they have to hedge out their risk because they don't want to hold that risk. And so they go push it on the market. Okay. That's what a structured product is. Now, we could spend hours here just going through all the different structured products, how they work, and what they're, and it's not worth it right now. But understand that overwhelmingly, these structured products are focused on the indexes. There are some in increasing growing amounts that are on single list options and baskets or pairs, et cetera. Those are getting more popular. But overwhelmingly, these structured products are tied to the indexes, primarily the S&P 500. Okay. And overwhelmingly, these structured products do two things. One, they sell vol. Why? Because there's a risk premium to vol, And over the long run, you make money by selling vol as long as it's contained and defined in X or Y way. Also, overwhelmingly, they are net long a buyer of some type of skew or convexity on the downside, some protection to sell that vol. So they are skew enhancing, they push skew up, and they sell vol. Not all of them, but over the whole, that is the effect. Okay. And to be clear, there are other things like structured products like ETFs, there are mutual funds, structured notes. I'm including all of these together because they do similar things. One of the more famous and well documented, talked about one that people will is JP Morgan's hedged equity trade. Right. This is a 25, 30, actually, I think it's at the $50 billion mutual fund, but it's essentially a structured product. It is a very simple thing. It just writes the same positions each time, writes and buys. It's a put spread versus selling a call. The call is essentially at the money. It sells a ton of vol. The put spread provides downside protection. And in that process buys net skew. Okay. This is a general type of structure that you're seeing. Okay. But understand that these participants that are doing this are doing it as a replacement, as I mentioned before, to stocks or bonds. And so when they do this, this is not like, these are not weak hands. It's not like they've, I bought a structured note, and so if it goes bad, I'm going to get out, right? Or I'm going to be forced out. They are actually, generally speaking, a deleveraged position to an equity position. They are also more non-correlated. They are not net long the market or net short the market, right? So understand that this is not like these effects don't mean that all of a sudden if we go down or this trade becomes bad for them, that unlike a XIV or some other type of thing that's selling vol, that can cause dramatic stress. Okay. Now these things have been known. We saw this with snowball structured products, right, in China, and we've seen other effects where banks can get mismatched on these massive positions. They're laying it off, but they can't lay it off exactly. And into a very risky situation in the market, these structured products and the effects can drive more stress primarily at the bank level. But understand that the end buyer of that product is not, it's kind of a replacement to equity type positioning, and in general, less risky than equity positioning. So they don't get forced out of this scenario. All right. That's what structured products are, just to kind of make sure we're clear on what that is. And then very different than the hedge fund exposure. Those are different things. These structures have grown from 500 billion to 2 trillion, as I mentioned. That is causing a dramatic amount of vol compression. And importantly, it's connected and tied to primarily quarterly options expirations, right? So that's very important. It's primarily focused on the S&P 500, so that's important. That's why the dispersion happens. And again, it's primarily generally structured in a very consistent way because they're just structured and people buy certain things. That is what is driving the compression. I want to also highlight that when the markets are busy, like the size of this issuance is similar year round, right? And it's consistent around the clock. But volume that can absorb this liquidity is not consistent year round. In the summer and November and December at the end of the year, right? Guess what? Volume goes down. Holidays increase. There's less liquidity.
Yeah.
So the effects of them are actually much bigger, not just at quarterly expirations, but in the periods where times are slow, they become much more dominant. That's a big part of what the Summer of George is about. The difference between the Summer of George and, let's say, November, December, which have similar, by the way, volume and liquidity dynamics, is the end of the year also has this critical re-leveraging effect that happens based on reinvestment Jan 1 if markets are up and with the money made. And that creates, and it's an end of the year chase, right? That can be driven as part of that. So they have slightly different dynamics. But otherwise, May, June, July are very similar to November, December, mid-January. And so understanding those dynamics and how they play relative to volume, other dynamics like the leveraging effects at the end of the year, and specifically tied to the quarterly expirations is important. It's also important, though, to understand that the growth of these is increasing every quarter, every year, and the effects are also meaningfully more dramatic and are going to continue, as I was highlighting before, to grow at a dramatic rate. I've been saying this for 4 years. as we move forward. This is the beginning. This is where we've hit a tipping point with these things, and they are starting to grow. Because it's just simply too much on one side relative to the non-correlated. Again, why also are they growing? Not just because they're non-correlated, which again is critical, but they're also capital efficient. What do I mean by that? Options, by definition, are capital efficient. I can go get a 10-year bond yield, actually do better with a box, but we won't get into that today, right? Which is essentially an arbitrage equivalent to a T-bill. I can go get 4.25% and then collect whatever yield from a structured from the options positions on top of that. If I buy stock, I cannot also go buy a bond, right? But you can stack your returns. If I was getting in a structured product, which is unrelated to interest rates, 4% before, with interest rates at 0, now I'm getting 8.25%.
Hell yeah.
And so the appeal of this is not only that we're looking at a market that is expensive and dangerous relative to history, and we want alternatives. That's a huge part of it, which I have highlighted. But these things are also incredibly more compelling when interest rates go up. And so interest rates are going up, which are also driving a lot of the risks on the 60-40 side. Right? The valuations are more dangerous when interest rates are higher as an alternative. But at the same time, structured products are benefiting from that capital efficiency and able to be a much more compelling alternative. So if we start to see an increasing interest rate environment, which we've been seeing for some time, that will also reiterate the growth of structured products at the same time. The reason options came about in the 60s and 70s, this is 1972, the SIBO was created. The first, or 71, I think it is, the 73 or 74, 75, I forget what year it is. The put option was created, right? And structured products and these ideas started in that period. Hedge funds also started in the 60s and 70s. Why? Same exact reason. Rising interest rates and need for capital efficiency. I could get a 20-year, a 10-year bond for 19%, which is what you were getting in 1982. Right? You want to be able to still collect that yield and make money on top of that. And those become a dramatic alternative and very compelling because they're very profitable relative to a 60-40 type investment strategy. So this is what's going on in structured product. I know I kind of cleaned it up and told you kind of but that's what's driving the growth of them. It is, again, very compelling in the context of what the alternative is. These are true alternatives, and they're non-correlated in the sense that you're making a bet that is not just about markets up and down. Back to our conversation about path and up and down versus other alternatives. Options allow for betting on different parts of the distribution, often simultaneously, without just betting, hey, is the market going up or down? And that's what structured products do. They allow for positioning in a dynamic way that allow to collect a yield, bet on certain outcomes simultaneously, much like a parlay or betting terms or something like that, right? But these are very, very kind of path-dependent bets. If this stock doesn't go up more than 20% and this stock doesn't go down more than 40%, then you get X. This is a great type of example, right? Or if the index stays between up 20% and down 20%, you make X. Well, that X ends up being 4.25% plus whatever premium they collected from selling a put and a call at X expiration. That's a great example. Now, to your average person, they don't think about that options position. They just say, "Oh, I like that. I think that'll happen. I'm going to make that bet." And meanwhile, the casino or the bank who's issuing it collects their VIG and lays off the risk in the market at fair value. Okay. So I'll leave structured product conversation there, but that's what a structured product is, and that's why it's having the effects of it.
Gotcha. So back to, I don't even remember where we were with just, I guess, going into from Friday's highest gamma OpEx and to where we are now with, we've got the threat of, I don't know if I should call it the threat, depending on your perspective, of the Fed potentially lowering rates in the next month or two. In September, I believe, is when it's expected. And then, of course, you got the new Fed chair candidate, Mark Summerlin, who's supporting a 50 bips rate cut because of the inversion curve. And then, there's the freak out that if this happens, a lot of people are afraid that then we'll just go right back to runaway inflation, and then it'll just cause this reflexive loop where, yes, the S&P could go to 7,000 and mortgage rates could come down, but we'd be dealing with the same thing that we've been dealing with, which is just inflation not only staying strong, or not only staying firm, but perhaps going up again because of a low interest rate environment. What are you thinking is?
Yeah. So you're focused on the macro parts, right? Which is what the overwhelming majority of people think about. But the flows, as we've seen this summer, can often have little to no connection to the macro. When I say macro, by the way, the macro will matter in the sense that it matters to the extent that it creates supply or demand, right? And so liquidity, right, which can be driven by macro, often is, not all of it is, but much of it is. That part is important to measure and think about, right? But the macro that is not going to directly affect supply and demand in the market, think geopolitical, things at least that aren't drawing somehow on liquidity, generally don't matter in the short or medium term even.
Sure. I mean, we
and
see it
so-
all the damn time.
Yeah. And that makes sense, right? Because of the short term, the market's a voting machine. How many buyers versus sellers are there? And the long term, it's a weighing machine, meaning valuations, et cetera. Eventually, by the way, how do those two things converge? Because at some point, the voting machine and the weighing machine have to converge. They converge when that weighing machine, right, meaning the valuation of things and whether that's worth buying or not, and to the extent that drives supply and demand, or supply and demand is such that there's not enough liquidity, and all that matters is how much money does a company make? Can they support their own growth? We've given the analogy here many times, but I think it's the best one out there. It's the path of an airplane is determined by the amount of fuel in the tank. It's not determined by how far off the ground we are until you run out of fuel. And if you want to know how the voting machine and the weighing machine converge, eventually you wait long enough. It's not a smooth path, but you wait long enough, eventually that fuel runs out. And predicting when and how that fuel runs out is important. But when it runs out, all that matters is how far off the ground you are. And so fundamentals converge when liquidity dries up. And again, think about the SPACs. Think about kind of tech bubble is a great example. We were just talking about it, right? Did it matter where the valuations were in 98? No, it didn't. All it mattered is how much fuel was there in the tank. And there was a lot of fuel, and there was a lot of squeezing to be done because institutions were short in 98, just like now. And retail had a ton of money in their pockets. We were in a surplus. A lot of liquidity was being created. The narrative was there. We were in peace, irrational exuberance. Call it whatever you want. But realistically, the Fed was stimulating lowering interest rates to historic levels relative to where they had been. And there was more liquidity due to the amount of money flowing around. And that drove the plane to not 30,000 feet, not 40,000 feet, to 60,000 feet. And then guess what? But the engine ran out of gas. And then it dropped 92% in the NASDAQ. So my point is, we could talk about how far off the ground we are, but talking about how far off the ground we are as a context for predicting where the plane is going is a fool's errand. It's a risk management tool. Valuations and fundamentals are a risk management tool. Eventually, by the way, as I mentioned here, when you're in a bubble, you will find yourself reverting eventually back down. But how long that takes and how, that's a matter of measuring how much fuel there is in the tank. And so what we do here and what we should be doing is measuring how much fuel is in the tank. That's our primary job in terms of predicting path. Now, when you're predicting path in terms of short, medium, long, eventually you have to take into effect how far off the ground you are. Because if you do run out of liquidity, right, question is, how much are you going to fall? And before liquidity can be provided again, and what are the context of that? And so that those things matter for broad prediction and path. But I want to be clear, we could end up in the same place in 2 years with dramatically different paths. We could go up 50% and then down 80%, right? Or 90%. And that, or we could just go stair step down to, 40%, or, however you want to kind of think about it. And those are very different outcomes, by the way. They're different for volatility. They're very different for, what you play in, and how much. In one of those scenarios, you may make a tremendous amount of money, and one of them you may lose a tremendous amount of money.
No, I'm going to make a tremendous amount of money for sure.
But you could position for both, by the way.
Yeah.
And sell the other pass and make money in both scenarios.
Speaking of the stair step, the last couple times that we spoke, I believe that was still your running kind of prediction, and emphasis on prediction here, folks, that after August OpEx going into September, maybe even after September, is when we would start to get that stair step down. Do you have any kind of update on what your crystal ball says? Because VIX expiration is tomorrow. We had the SPX expiration on this last week. What are you thinking? What are you seeing?
So, yeah, this is in 52 weeks in the year. This is either number 1 or number 2 for the most dangerous week. And that's true historically. But it's also true increasingly because of the issuance of structured products and hedge fund positioning and what's happened this summer.
Let's keep going up.
So yeah, but that's this week. We're not talking about this month or next 3 months or 6 months or 9 months, right? And so if you say, Cem, what's people have been asking me this last several days, what are the most highest odds for the next week or two? What are the highest odds for the next 3 or 4 or 5 weeks? The answer is 60-40. Odds are we go down. I don't think it's a vol event. I think that's a low probability that we get some big vol explosion. Market down, vol down would be the most likely path. But to be clear, what does that mean? That means, in the next 2 to 3 weeks, 3 to 6%. All right. And if we go down 3 to 6% in the next 2 to 3 weeks, especially on the long, 4 to 6% side, maybe a little bit on the higher side, 4 to 7%, you're more likely to then activate the significant risk that exists on the put wing. This is that gamma we've been talking about. The short gamma, by the way, not the long gamma. The short gamma and short vega of the SEP OpEx, structured product and put positions. I want to be clear. Big koi OpExes are not more bullish or more bearish. The expected value of the distribution is the same, but the shape is very different. It is right distributed with a fat left tail. That essentially is driven by dealers, the whole world being short that put on the downside and short stock, and time passing every day. If time passes and those puts, which are out of the money, go out of the money, they have a tremendous amount of stock to buy back, which is what those Vaughn and Charm flows are. Those are Vaughn and Charm are just measures of time and implied volatility that change the delta of those options positions, which drive the buyback of those flows. But the other side of that coin is the short gamma. And so, yes, if time passes and nothing happens, you have stock to buy back. The dealers have stock to buy back. If vol compresses, you have stock to buy back. But what happens if the market goes down and vol stays steady or even goes higher? And what happens if you move down fast enough where their risk of that position gets worse? Well, you got to sell stock. They got to sell stock into that, not buy stock.
Then that becomes reflexive in its own right.
Correct.
Yes.
And so this machine, this is why distribution, right? We're not talking about is this bearish or bullish. That is incredibly valuable information. If I know that if X, then Y, that doesn't mean we're going up or down. But I know if X happens, I better have Y. And that also reflexively, to your point, will then drive different outcomes. And that's why the left tail is fat. Because if we go down, it could drive continued downside and stress into SEP OpEx. But if we don't go down fast enough, it's not just down. Like we can go down, but go down slow enough where the supportive flows are still very consistent and pushes back up. So it's important to understand this dynamic. And if we're likely to have this kind of, again, I hate the window of weakness term, but it's an easy way to say it, but it's a window of non-strength, not nearly as sexy. That means there's just not enough, all the demand that was pushing into the August OpEx is now gone.
Right.
Because we're now on the other side of the tub, the drain, there's a new drain, and with SEP OpEx 5 weeks away. And so until we enter into the kind of the buying of stock because we're closer to expiration, they need to cover the deltas. Until that happens, if we can start to push down in this period, but without those supportive flows and then activate it, that can be stressful. And so what do we need to activate that? Probably 4 to 7%. I said 3 to 6, 4 to 7 is more accurate. And if we do that, then guess what? Then you can really see some more stress in that window. It'll be more volatile because it'll be the buying back, and then there'll be the, oh no, we bought back and now we're going down. It becomes a much harder time to navigate with all the open interest. And so if we do that, and then we get to something, let's say by SEP OpEx, that given that they get stressed and we get something like 7 to 12% by SEP OpEx, right? Which is kind of the stress from all that driving this decline. And by the way, this is how we, to the day, called the Fed March, beginning of the Fed March decline recently, right? Like people have very short memories, but we called that 6 months in advance, almost to the day.
I remember.
By the way, in COVID,
well, that was the big one, man.
Yeah.
It was like the day after that OpEx.
Yeah. And it started the day after that Fed OpEx, ended the day after the March OpEx, almost day to day, cycle to cycle. And that's not a coincidence. But the point here is Fed March is very similar. I said June is different because of the summer. December is different because of the end of the summer and the sort of flows. But the two most dangerous otherwise are that Fed March cycle, right? It really, otherwise Fed March and then again this August. That's why I said 1 to 2 are the most dangerous weeks are these weeks. And so point here is, this is a similar setup. One, to be very cautious and careful about, particularly given the rally we've had, particularly given the deleveraging we've seen from hedge funds, which was the primary driver of the squeeze this summer, which has now been massively delevered again. The gross deleveraging at hedge funds, to reiterate, is the biggest that we've seen since the COVID collapse, with nothing going on. That's how big the interaction was between structured product issuance, dispersion, and hedge fund long short pain. Okay. And that drove, because they were short this time around, a squeeze higher this year. Now that's been, that deleveraging has happened to a great extent. They're still underweight, but that's happened. And that now is likely, without the bid here and with the loosening of that the deleveraging that's happened in hedge funds, likely to see some mean reversion. Question is that mean reversion going to be big enough to activate that SEP OpEx risk? And if it doesn't, you will see a pushback up. And if you see a pushback up, guess what? Now you've gone all the way through SEP OpEx in one of the biggest potential risk times. And on the other end of that, not exactly on the other end, but October Halloween, end of October, we only have about a month and a half left for something to happen. And the odds have dramatically dropped by then. You don't have that SEP OpEx open interest that's still there to potentially drive the decline and the pull of liquidity out of the market. And then you have to start looking forward to November, December, January again.
Right.
Which is not all that different than the summer, but even worse in terms of even better, I guess, for markets, because then there's this releveraging effect we talk so much about, which when the markets are up for the year, there is a reinvestment that happens Jan 1 that is in the many trillions of dollars, right? Which helps to drive this chase into the end of the year, paired with, again, that summer, the lower vol, the compression from all these structured products, all the hedge funds who are still net under levered, and again, the retail squeeze can start to go again. And never mind the administration, which you kind of highlighted in the amount of liquidity that they are intent to provide to help push on that squeeze, which they've been doing this summer as well. So it is, if you look at the full sum, there is a very much a dynamic in place between hedge fund underweight right now, structured product issuance growth and the vol compression that causes, the fact the market's already up 10%, the fact that the Treasury is lowering issuance and doing silent QE essentially and doing everything they can to keep things going. Between all of that, there is an overwhelming probability that unless we get something soon here, that the squeeze gets going again into the end of the year. But we can simultaneously be big picture bullish, probabilities good there, and be 60-40 bearish here, given the mean reversion of the summer and what we're seeing. And the question is this mean reversion that we're likely to see here going to be big enough to activate that stuff? And by the way, if it does, then you get into a period where there's likely to be after Sound of OpEx some type of a bounce. And the big question is, will that bounce be big enough to get momentum to squeeze higher? Or will institutions and hedge funds who have been net underweight, will they have been buying that whole dip, which is likely, especially if it's stair steps and manageable. Will they have been bought up? Will retail continue to buy that dip? Highly likely. And at that point, will the balance of power be, well, people are really long and they're playing for the end of the year rally, and then it doesn't, because we still have another month and a half there till the end of October, early November. Will we then see a extension? And we'll have to see. We'll have to see how much buying has happened at the institutional level. If this all happens, how much has happened at the retail level, and can we get the momentum? I would argue that you're really trying to thread a needle here, because you need this decline, but you need it not to be too big either, because if vol expands too much, then you get that classic vol compression, V bottom, and things start coming back.
Yeah.
So not likely that at this point we get a big enough move at the rate we need to activate and lower the market. The market essentially needs to drop about down 5% for the year, which is another 9% lower from, another 13% or 14% lower than here by the end of October. And it needs to do it in a way without a big vol event. And although I think those odds are higher than people expect, I still think that it's too many if-thens and more improbable than not. And if we do not do that, then, again, let the good times roll, and this thing will. But I also think, importantly, the rally that we're likely to see if that happens is going to be very memey again, very narrative focus. It's going to feel a lot like it did this summer, and it might even be crazier.
Yeah,
probably would be, because now you have the benefit of all the flows at the end of the year and the vol compression and whatnot. And so you could really see a chase, and that could go to the middle of January. And no liquidity. This is the great irony. There's no bigger producer of liquidity than the market itself. There are basically 4 or 5 major sources of that gas in the tank. Okay. One of them, let's say, bank lending, but which they're trying to help with the SLR stuff. But let's say that's less important. 4 major ones. 1, the biggest one, markets themselves. 2, the Federal Reserve. 3, the United States Treasury. And 4, the economy. Economy is actually probably the 4th on that list. Right? If stocks don't make as much money, or people don't make as much money, they have less liquidity. But ironically, that's actually less important to markets, because the people who are making the money, generally speaking, right, are not the ones buying stocks. That's not the majority of stocks. How much companies make is not necessarily representative fully of the economy, but is important because that drives how much buybacks they create. But that's pretty much the only way that the economy drives liquidity. The biggest is the market itself. As I mentioned, 500 trillion or so of total assets, stocks and bonds. If that decreases by 10%, That's $50 trillion of liquidity pulled out of the system. $50 trillion of collateral that's just gone. And so the great irony is it's a reflexive loop. And so these little things like path, as much as people are like, okay, like how much does that matter? Seems silly. Because we're so financialized and most money is leveraged and all of this market action, people call it the wealth effect. It's much more important than just wealth. It's not about people's wealth. It's about collateral, primarily at the institutional level. But that driver of liquidity is the most important thing by far, more important than the Fed, more important than the Treasury. And the Fed and Treasury are trying to manage that as much as they say they're not. And the economy can drive some of that as well. But yeah, let's see what happens in September. Very important to the outcome in total, because the end of the year is like a magnifying glass. And if we can decline enough, that end of the year magnifying glass then turns negative. That's the critical part.
Right. Hopefully we don't get like a September 11th too, because that would probably
That's correct. And by the way, I do want to highlight there are counter, like the decline that happened in 2018 is the perfect example of, hey, we didn't get a September decline, but OC1, which is when that started, it still had a month to go. And there was enough of a surprise in terms of a decline in October, then it then activated a negative loop into the end of the year. So you're really not safe till you get to early November.
Mm-hmm.
And there's no such thing as a sure thing ever, right? But your probabilities increase as you go. And that SEP OpEx is a critical point here. And again, I think, given that we're already up 10% for the year, or 9% now, highly likely that you're going to need a 15% type decline by the end of October. And the question is, what are the odds of that? And again, if at post SEP expiration, if we haven't seen at least some reasonable portion of that, I would say at least 50% or more, because you're going to get some bounce back at some point. Your odds have diminished, and especially given the probabilities of everything else we've talked about with structured product issuance and underweight from hedge funds, the releveraging effect, the odds are increasingly high that you start to get some type of blow off top. And once that gets going, by the way, next year is a midterm year. The fiscal spending will come in response to the economic slowdown that we're seeing. The Fed chairmanship will flip over to Trump in June. Dangerous year to try and short the market into a bubble. And so, yeah, could this go on till December, January 26, 27? Yes,
Jesus.
it could. And I think it's increasingly likely unless we start to see something here in the fall.
Yeah.
And again, there's a window for it. You got to thread the needle. Markets love to thread the needle. Markets love to push things to the absolute decision point.
Yeah.
And the economy is slowing meaningfully, as we're seeing from unemployment. And PPI was super hot. So we're getting that stagflation we thought we'd see. All of those economic things are, even though the fourth most important thing, are an important drag to liquidity. If we start to drag down and the market starts to come down here in SEP, you can see worse numbers, worse liquidity, and those things can feed on themselves. So, so you see how they're paths. You can play both. We can go long, call most convex things on the upside in January. Play for a very, very 4x, 5x, 10x type return things, while still hedging out for a stair step down, which is really what we need here in the next month. And you could do that and profit from both sides. Okay. And you don't have to just be long stock or short stock. And those paths can be funded, by the way, with lots of the other paths that are highly unlikely and not probable.
Well, as we wrap up here, there's one question someone's got in the chat here on YouTube. It comes from Alan Beauchamp, who asks, how do we measure the fuel as it relates to the Greek exposures on a day-to-day basis or for the current week?
Yeah, so you have to know what the actual size of the positioning is. You have to understand. So if you know what the positions are, and then you know what the reaction function is of the dealers who are holding those positions, which are the ones that really matter because they're the ones that are rehedging the positioning. The customers just take it as a hedge or as a directional bet, right? But primarily the dealers, who are the ones holding this net positioning, are hedged and have to re-hedge their positions as time passes, as implied volatility moves, and as the market underlying moves. So you have to look at gamma, you have to look at vana, you have to look at Cahn, and you also have to look at their interaction with VOMA and Veda, which are the Vega, and how much the Vega, they're getting longer per amount of time and per amount of change in volatility. And so you take those, and again, I wish there was a simple answer for me to tell you, but you have to take that positioning as you see it, measure the hedges, and measure then the change of effect based on that rebalancing. And then you have to take how many dollars of rehedging is there in what way, given different outcomes. And then you have to measure that relative to liquidity, because that amount of flows does not have the same effect per percent or per move, right? In different scenarios, you have to understand how much liquidity is there to absorb those flows, and also, and last of all, what other flows are there? Because these are not the only flows; these are just these flows,
Right.
And so, if you're talking about, that's that fuel, but there's other fuel, and there's other, removal of fuel from the tank. And those are the other things we're talking about: the Federal Reserve, the Treasury, the economy, right? And again, markets themselves. And so these are all dynamic reflexive parts, but they're measurable. And if you measure them properly and you think about them in the context of one another, you can really draw dramatically more probable paths and dramatically less probable paths. It doesn't mean that you are going to pick up, down always correctly, but that distributional advantage is a huge one, and actually much easier to do than to pick up, down at any given moment.
God damn. Jem, every time I talk to you, I just realize how stupid I am. So thank you for that.
No, sometimes you've seen speaking of distributions, the distribution of,
yeah.
sometimes being too smart is also, sometimes it's easier just to YOLO calls when you're in the right environment.
Man, it
And
works for
so
some people. I swear to God. Some of these guys sharing their Wall Street bets screenshots, I'm just like, it pays to be
that's
a
how you made
moron.
money this summer. I want to be clear. That's how you made money this summer. That's how you made money. And there are incredibly profitable convex bets. And by the way, options themselves are incredibly useful for not just hedging or playing distribution, but making bets.
Yes.
They are bets, and they are the most precise way to take convex bets. And there are times where, particularly in this environment, given the flows, that you can make tremendous convex bets with relatively little risk, based on environment and flow. So you don't have to be that smart necessarily. You don't have to know all this stuff. You don't have to be an expert in this stuff to understand the value of options, start using them in a constructive and profitable way.
Yeah. Well, it's been very educational as always. Thank you so much for joining us. Thanks to everybody in the chat for joining us as well this week. And yeah, it's going to be interesting. Yeah, like I said, today felt like it was a 1 to 2% drawdown, and it just wasn't. And it's just, yeah. It'll be
The
interesting.
expiration tomorrow is very important,
Mm-hmm.
because it's the expiration for the SEP options themselves. It is a source of supply of all, and maybe the last one for 4 or 5 weeks. So it is likely to be kind of little vol dampening in the morning. But look for kind of, once that's done, that's kind of the last supply of vol. And a little market down, vol down is generally what we'll see at the beginning. But at some point here, if it continues, you'll start to see some expansion of vol on the downside. So let's see. Next month when we talk, very different look. We'll have a lot more information. And I have a feeling, we'll see here, that market's going to take this to a very interesting decision point, which will not be easy for either longs or shorts, because that's what markets do. And that decision point is probably
I love it,
Again,
man. I just
5 to 10%, 5 to 9% below here. So let's see where things end up. But yeah, I would not be
yeah.
surprised if we were down 7% or 8% or something, peak to trough by the time we're on the call on here next time.
Well, I'm well positioned for it, so that means that it probably won't happen. So I'd like to apologize to everybody out there holding puts. It's my fault. So
By the way, I don't think puts are the right way to play that. I think we'll
gotcha.
get
Cool.
market down.
No, even better. Is it selling calls?
Selling calls will work pretty well, but I think
Yeah.
there's some combination. You can talk about that. But.
Son of a bitch. Crap. Sorry, I had to get that out. Anyway, thanks again for joining us, Jim. It's always really, really nice to talk to you. I always learn something. And yeah, we'll see you next time.
My pleasure, Garfunkel. I appreciate
All right.
it.